Well, much like the post-financial crisis environment, this market likes the massive liquidity injections that the Fed has been putting forward. So the Fed has drove rates to zero. It's improved the credit markets. Most investors are kind of under-equitized right now. There's $5 billion in money markets. And so markets are moving higher as a result of that liquidity. However, we have to face some reality in 2021, and that is that we're going to have economic carnage on the street. We're going to have very slow rehiring of the jobs force. We're going to have a lot of failed businesses. We have reduced stock buybacks, lower dividends, and at some point this market will have to either find the Fed that's going to be more accommodative again, inject more liquidity, or face the reality of lower earnings in 2021.
Well, other than that, how was the play, Mrs. Lincoln? I mean, can you?
Well, I haven't been on a flight, so or a plane, so I wouldn't know.
Yeah. I mean, okay, I get everything you said. And, you know, the market, Carrie, has sort of, you know, moved away, if you will, from the reality of Main Street. And it's been, you know, the case has been made many times that the stock market is not a reflection of what's taking place on Main Street. You can't really argue with anything that Rich Saperstein said, but there are those who continue to make a bullish case for stocks. Maybe the reopenings are going to go much better than feared.
Sure. So I think what you're saying, Scott, is what the market is thinking. The market has been looking beyond this current period, definitely beyond the second quarter. This second quarter is going to be abysmal. It's probably looking at the fourth quarter into 2021. So now we're close to 3,000. We're at a level of resistance. The market is bouncing up against the 3,000 level on the S&P. We're going to see if we can break through it. As Josh said, it's trying to broaden out in a way to get through that level. And if it does, and Tom Lee is correct, that 3,600 is a attainable level for this year. What are we talking about for earnings of the S&P? So he's got to be assuming that we're back above 160 on S&P earnings next year. That would be the level of around 2018 and 2019. Remember, 2018 was a very strong year. All cylinders were on track in 2018, and this coming year might be tougher. So we're facing the reality at this level on the S&P, having gone up 32%, where we have to see which type of sectors, which companies, what's going to work. It's not the whole market. What's driven the market, as Josh said, is growth companies and those that have been able to maintain their earnings and have looked through this, have gone through this well, and are going to continue to expand. And as we talked about before, their share of S&P earnings is growing, and that's why their market capitalization has grown as well.